Morgan Stanley completely obliterated Q2 consensus this morning. Top-line revenue came in at a staggering $21.3 billion, which is a massive beat compared to the street's expectations and a huge leap from the $16.8 billion they posted in the exact same quarter last year.
Oh, absolutely.
And on the bottom line, we are looking at net income of $5.6 billion, translating to an earnings per share of $3.46, absolutely crushing last year's $2.13.
Yeah, and you have to note that management's forward guidance is just aggressively bullish on capital markets activity going forward.
Right, and we are already seeing the stock react, trading up significantly in the pre-market as investors digest not just the operating leverage, but a colossal new capital return program. We are tearing down the entire Q2 2026 print for you in this deep dive.
Because the headline numbers are aggressive, sure, but the quality of this beat is what really matters.
Exactly.
You don't see a 26% year-over-year jump in net revenue at a mature, globally, systemically important bank just because of, a lucky trading quarter.
No, definitely not.
What jumps off the balance sheet today is the operating leverage. I mean, they grew their top-line revenue by roughly $4.5 billion, but they managed to flow a disproportionate amount of that directly to the bottom line.
Which immediately points us to the expense efficiency ratio. For the first half of the year, that ratio dropped to 65%.
Wow.
Right? Because a year ago, it was sitting at 71%. In the banking sector, a 600 basis point margin expansion on a $20+ billion quarterly run rate is, it's an ocean of free cash flow.
It really is.
They are fundamentally spending less to acquire each dollar of revenue. And looking at the footnotes, this wasn't organic margin drift. This was manufactured.
Yeah, it was heavily engineered. To understand this 65% efficiency ratio in Q2, you really have to look back at a very specific strategic action they took in Q1 of this year.
The severance costs.
Exactly. Management recognized a $178 million severance cost. They executed a global headcount reduction of about 2%.
So out of roughly, 83,000 employees worldwide?
Yeah, about that. They cut approximately 1,600 roles.
And the breakdown of those cuts was highly targeted. It wasn't just a blanket corporate trimming. They took $94 million of that severance charge in institutional securities,
Right.
$61 million in wealth management, and $23 million in investment management. They basically went division by division, identifying bloat.
Which is exactly what you want to see.
It's like tuning a race car.
Right.
In Q1, they pulled the car into the garage, took the engine apart, and stripped out 1,600 redundant parts to just, make the chassis lighter.
I like that analogy.
Yeah, so it cost them time and a $178 million upfront penalty in the garage. But now, out on the track in Q2, that lighter car is burning significantly less fuel per mile.
Right.
That is the mechanical reality of a 65% efficiency ratio.
And that weight reduction is essential because, fixed compensation costs are the heaviest anchor on a bank's balance sheet.
Oh, for sure.
When you lower that fixed cost baseline, every marginal dollar of revenue generated by the remaining staff becomes exponentially more profitable. But to your point about the race car, a lighter chassis doesn't win the race if the engine isn't actually producing horsepower. Operating leverage only works if the top-line revenue actually accelerates.
Which is exactly what happened here. The classic Wall Street machinery just woke up. The institutional securities division, the side of the bank handling corporate advisory, underwriting, global trading, they printed $11.0 billion in net revenue.
Unbelievable.
To put that in perspective for you, they were at $7.6 billion a year ago. That is an absolute blowout for the institutional side. Let's break down the pillars. Investment banking alone was up 58% to $2.43 billion.
And the earnings release explicitly ties that $2.43 billion to higher completed M&A advisory, particularly in the Americas.
Okay, so deals are closing.
Exactly. We are seeing a major thaw in corporate deal-making. Sponsors who have been, holding assets through the volatility of the last 2 years are finally finding the exit windows.
Right. They can finally sell.
And alongside that, equity underwriting just surged. The IPO window is wide open, follow-on offerings are getting priced, and convertibles are moving.
It's a risk-on environment.
Yeah, it signals a macro environment where corporate boards have the confidence to issue equity and institutional buy-side firms have the actual risk appetite to absorb it.
And equity trading definitely confirms that risk appetite. That was up 69% to a record $6.3 billion.
Huge.
Yeah, the firm highlighted notable strength in Asia alongside just really robust client engagement globally. And even fixed income, which, can sometimes drag when equities run hot, that was up 13% to $2.45 billion driven by corporate credit and securitized products.
So the institutional engine is firing perfectly.
It is. But I do want to play devil's advocate for a second and check the dashboard for warning lights.
Sure, go ahead.
Digging into the institutional segment data, there is a $71 million provision for credit losses. And the release notes this is specifically tied to corporate loans and commercial real estate.
Right, CRE.
Yeah, and we know the macro headwinds facing CRE right now, right? Office vacancies, huge refinancing cliffs. Is management under-reserving here? I mean, is there a crack in the foundation we should be worried about?
That's a fair question. But a $71 million provision against an $11 billion divisional revenue stream, it indicates a highly granular, idiosyncratic risk approach. It's not systemic panic.
Okay.
If they believe their broader commercial real estate portfolio was facing a structural contagion, you would see a provision measured in the hundreds of millions, if not billions, dragging down the segment earnings.
That makes sense.
Yeah, what a $71 million charge tells us is that they have identified specific, isolated assets, maybe a handful of underperforming office structures or specific corporate credit facilities. They've marked them to reality and set aside the reserves.
So it's just the cost of doing business.
Exactly. It's the standard friction of operating in a complex lending environment, not a crack in the foundation.
Okay, so the institutional side is generating massive transaction volume, managing its localized credit risk, and printing $11 billion. But an investment bank earning advisory fees is, at the end of the day, just a transactional business.
Right, you eat what you kill.
Exactly. You get paid once when the deal closes. The holy grail for these financial titans is turning that one-time transactional fee into a recurring, decades-long revenue stream.
And that is the crucial pivot point of Morgan Stanley's entire modern business model.
Right.
When their institutional securities division takes a startup public or orchestrates the sale of a founder-led company, billions of dollars of paper wealth are instantly converted into liquid personal wealth.
Yep.
The strategic imperative of the bank is to capture that liquidity the literal moment it is created.
Which takes us straight to the wealth management division. They reported $8.9 billion in net revenues, which is up 14% year over year, and they're operating at a very healthy 30.5% pre-tax margin.
Solid numbers.
Very solid. But the margin isn't even the headline here. It's the asset gathering. They added $148 billion in net new assets in a single quarter.
And the composition of that $148 billion is honestly the most revealing metric in the entire earnings print.
Yeah.
The release specifies that just over half of those inflows were related to IPOs in their workplace channel.
We have to stop and look at the mechanics of this because it is a completely closed-loop ecosystem.
It really is.
So for you listening, the workplace channel handles stock plan administration for corporations. If you work at a pre-IPO tech company and you receive restricted stock units, you track your vesting schedule on a Morgan Stanley portal.
Right. Now, assume the institutional side of Morgan Stanley wins the mandate to underwrite your company's IPO.
Okay.
They price the offering, the stock begins trading, and eventually the lockup period expires. Suddenly, thousands of employees have liquid wealth.
Real money.
Exactly. Now, traditionally, a newly minted millionaire would take that capital, transfer it out, and, shop around for a wealth manager or deposit it into a standard retail brokerage.
But Morgan Stanley has eliminated the transfer friction completely. The wealth is basically born inside their ecosystem.
Yep.
The employee's dashboard simply transitions from private equity tracking to public wealth management. The bank fundamentally bypasses the client acquisition cost.
That's the beauty of it.
Right. They aren't out there spending marketing dollars to hunt down high net worth individuals. They are structurally stationed at the exact choke point of wealth creation. Over $70 billion of net new assets this quarter came from simply catching the exhaust of their own investment banking deals.
It's an acquisition funnel that competitors simply cannot replicate unless they have a Tier 1 investment bank physically attached to their wealth division.
Right.
And when you run that flywheel for years, just compounding the assets, you reach the threshold they just crossed this quarter.
Yes, the milestone.
Across wealth management and investment management, which, by the way, quietly added another $1.6 billion in revenue and $7.5 billion in long-term flows, the firm has officially surpassed $10 trillion in total client assets.
$10 trillion.
Yeah.
That number completely changes the risk profile of the bank.
Yeah.
When you have $10 trillion in AUM, the baseline management fees generate this fortress of recurring revenue.
Exactly.
Even if the IPO window slams shut next year or, M&A activity drops to zero, they are still skimming basis points off a $10 trillion pool. It fundamentally de-risks the volatility of the institutional side.
Which perfectly explains their posture on capital distribution.
Yes.
When a bank is heavily reliant on volatile trading revenue, regulators and the board require them to hoard capital, to buffer against market shocks.
Makes sense.
But when you have a $10 trillion recurring fee baseline, your forward earnings visibility is incredibly clear. You don't need to hoard excess cash. You just return it to the shareholders.
And their capital return actions this quarter were very aggressive. They repurchased $1.5 billion of their common stock, taking roughly 8 million shares off the open market at an average price of $197.64.
Right.
The board also bumped the quarterly dividend by 15 cents to $1.15 per share. But the forward guidance on capital is what really moved the needle today. The board just authorized a multi-year share repurchase program of up to $20 billion starting right now in Q3.
A $20 billion authorization is a massive statement of intent.
It really is.
And to understand why a bank can authorize a buyback of that magnitude without triggering regulatory alarms, you have to look at the tension between two highly specific balance sheet metrics they reported today, ROTCE and CET1.
Right, let's get into that. The return on tangible common equity, the ROTCE, came in at 26.6%. Usually in the financial sector, if a firm is pulling near 30% returns on equity, they are levered to the gills.
Oh, yeah.
They're borrowing heavily to juice the returns, taking on systemic risk. So is Morgan Stanley just rolling the dice with aggressive leverage to hit 26.6%?
If they were, the regulators would shut down a $20 billion buyback instantly.
Right.
But they aren't. That is where the CET1, the Standardized Common Equity Tier 1 capital ratio, comes into play. This is basically the post-2008 regulatory safety net.
Right, the buffer.
It mandates the percentage of ultra-high-quality liquid capital a bank must hold against its risk-weighted assets.
Yeah.
Morgan Stanley's CET1 sits at a fortress level of 14.8%.
That is well above the regulatory minimum.
Exactly. So they are holding a massive conservative safety buffer, yet they are still generating a 26.6% return on their tangible equity.
Wow.
Mechanically, that is only possible because their revenue mix is heavily weighted toward wealth and investment management.
I see.
Those divisions produce massive fees without requiring the bank to put its own balance sheet at risk. They don't need to lever up to generate yield.
Right.
The 26.6% ROTCE is a product of high-margin, capital-light advisory fees, not toxic derivatives or dangerous lending.
And because the business is capital light, retaining excess cash actually hurts their efficiency metrics. If they just let billions in profits pile up on the balance sheet, their equity base grows. And that 26.6% ROTCE mathematically shrinks because the denominator gets too large.
Right. It dilutes the return.
So they initiate the $20 billion buyback. They go to the open market, buy their own shares, and retire them. They shrink the equity base.
And by shrinking the overall share count, every remaining shareholder now owns a slightly larger percentage of that $10 trillion asset management machine.
It's brilliant.
It mechanically drives future earnings per share higher, even if net income remains perfectly flat. It is a much more flexible way to return capital than locking into a massive dividend hike that might be, hard to maintain in a severe recession.
So piecing this entire Q2 print together, the narrative is completely airtight. The painful Q1 workforce reductions engineered a lean 65% efficiency ratio.
Yep.
The macro environment thawed, allowing the institutional side to print $11 billion on the back of surging M&A and equity underwriting. That institutional activity triggered liquidity events for corporate clients, which the wealth management division instantly captured via the workplace channel, pushing them over $10 trillion in total assets.
Exactly.
And because that $10 trillion generates capital-light, recurring fees, the bank can safely execute a $20 billion buyback while maintaining a pristine 14.8% CET1 ratio. I mean, it is a masterclass in modern financial architecture.
This synchronization is flawless. But, if we pull back from the immediate earnings beat for a second, the mechanics of this report highlight a structural shift that should terrify traditional retail banking.
Really? How so?
Well, the massive success of their workplace channel implies a fundamental rewiring of how wealth actually moves in the economy.
Okay, unpack that.
Historically, wealth creation was geographically dispersed. A company went public or sold, and the employees' windfalls landed in checking accounts at regional or local banks.
Right, the money went out into the wild.
Exactly. And those traditional banks relied on those massive deposit inflows to fund their loan books, and independent brokers competed to manage the assets. But look at what Morgan Stanley has built here.
The closed loop.
By administering the corporate stock plans, they trap the wealth at the cap table level. The money is captured before it ever hits a retail checking account.
So the wealth never sees the open market. It's born institutional, and it just stays institutional.
Exactly. And if the top global banks are structurally capturing the liquidity events of the modern economy right at the source, well, smaller, traditional banks are going to be permanently starved of deposit and asset growth.
Wow.
We aren't just looking at a great quarter for one bank. We might be looking at the mechanism that slowly suffocates the traditional retail banking model over the next decade.
It really reframes the entire earnings report when you think about it that way. That $148 billion in net new assets isn't just a sign of Morgan Stanley winning. It's a sign of everyone outside their ecosystem losing access to the capital pipeline entirely.
Exactly right.
Well, this has been a massive breakdown of Q2 2026. If you want to keep exploring the mechanics of the market, the macro trends, and the real stories hiding in the balance sheet, be sure to follow the show for our daily earnings coverage. See you next time.